family opportunity mortgage, what it is.
But first, let's hit it. Hi, it's Alan Victoria. Welcome to our Talent Podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
That's what we call and text all the time at 252-327-3357. We love talking to you, so don't be shy 100%. Now, I didn't even know what a family opportunity mortgage was, and we've been doing this for a while, but it's a growing thing or a new thing that we think you should know about now that we have learned about it and we want to share it with you.
Exactly. Basically, what we wanted to share with you, because as you know, if you are not basically occupying a place as a primary residence, your mortgage is going to be more expensive.
Your interest rates. And if you want to buy a vacation home, it's going to have to be 300 miles from where you currently live. These are not the ideal situation when you're talking about your parents. And for me, this really is a personal choice right now because my dad has Parkinson's. The question is, what happens to mom after? And so this type of mortgage makes me think, hey, I can do this in a way to help to where she could get her own home. And that is what I wanted to throw out at the beginning.
Exactly. Therefore, according to the Fannie Mae, basically, this is a solution for the child to provide housing for his or her elderly parents that they are not able to work, or you have really sufficient income to qualify for type of a mortgage.
Now, this is a mortgage that's basically designed for people like me to help my parents or your parents get a loan to buy a home that's not 300 miles away, which isn't going to work for me, and it's going to meet less requirements, and it's going to still get an interest rate that is much closer to what I pay for my primary. So as long as we're using this, it's either, and you can also use this loan if you are an adult parent who has a disabled child who cannot live independently. So you can buy a home this way as well.
Exactly. As long as you meet certain basically requirement that we're going to address in this video and podcast, you're going to be eligible to provide a home for your elderly parents.
Which I'm excited about. So let's talk about the benefits of it besides just, me saying this is a good thing. The primary benefit is an adult child or a parent currently owns a primary. The new loan is subject to the same guidelines and interest rates as owner-occupied homes.
Which is great, It's amazing.
Right.
The number two...
Therefore, the Fannie Mae is allowing us to buy a home even though you don't plan to live in it directly. And typically, if you are looking to our second home, you have to put a larger down payment. Interest rates are higher, but that's not true for what this loan is, and that's great.
Exactly. That's what we said. You're not doing really investment as a part for the mortgage, and you're buying it as a primary.
Right, number two.
Number two, the good thing is your parents don't need to be on the mortgage.
So if your parents were a little irresponsible, it doesn't mean that you can buy it yourself and have your parents live in it and still get these interest rates. Number three, basically this program allows you to have a down payment as small as 5%. And also get a reasonable interest rate that depends on the market. Now, lenders' best mortgage rates are going to be for owner-occupied, and that is basically the interest rate you're going to get. What the interest rate is the day you're actually buying this is going to depend, of course, on lots of things, but you're getting the owner-occupied interest rate, and that's great.
And number four, basically, this means that as a child, with the aging parents, you can supply housing for them and obtain the same rate, the same fees, and basically the lending flexibility to buy a home for them.
Again, you don't have to live with your parents in order to buy this home. You are getting special accommodations so you can buy this house for them. Your parents are going to live there and remain living there, till they don't need to live there anymore. It is typically, if not for this allowance, typically if I was looking to buy a home for my mom or dad in the future, I would have to buy it as a second home, an investment property, and that's going to be much higher. And also, as I said, second homes need to be how many miles away from me?
Basically, it should be 50 to 100 miles away.
So that's for investment, which means that's not necessarily good if I want to go take care of my mom or dad, right? And investment properties also need how much money down?
At least you need 20%, sometimes to 30% to put down for that kind of house.
You're also going to get harder qualification criteria, higher interest rate. So by relaxing this guideline, it's allowing people like me to help their parents, and this can make a huge difference on affordability.
Yes, now we're going to talk about the guidelines, because the purchase basically is considered as a owner occupied, because you put your parents as the owner. The buyer can put as little as 5% down payment, as we said, and also obtaining a mortgage insurance policy, no?
Right. So the reduced requirement is lowering the initial cost of buying this home by at least $30,000. So, because if I'm buying a $200,000 home, what is 20% of that?
$40,000.
And how much is it if I have to put 5% down?
Basically, it's $10,000, no?
This is just really simple math that
Simple
I just threw
math.
at him.
Therefore, you
We can
save
do it more.
$30,000 up front.
Right. And not classifying this as an interest investment property means that interest rate is not going to be raised by that 0.5 or $45 a month on $150,000.
Yeah, and then with the assisted living cost that basically is skyrocketing, also is really a cost-effective solution for your parents to live in a home with this kind of situation.
Now, you might find the mortgage is a fraction of a cost of a nursing home, assisted living facility, and then if you combine buying a home with in-home nursing, home health aides, it is more affordable. So this is a great solution we just wanted to throw out there, because this is something I've really been looking into for my own self, and I'm happy to help you with it as well.
And then, so we are not finished.
Oh,
We're
we're
gonna
not?
give you
I'm so
how to
sorry.
get qualified. No, how we can get qualified.
I put him on the thing to find out. So to get qualified from me, of course, is we need the proof of who your parents are. Especially if you have different last names, your birth certificate's gonna work just fine. My parents' pay stubs if they have it, your pay stubs if you have it, your parents' social security award letter, how much they're getting, to prove that they can't afford this fully on their own.
Exactly. Therefore, you need really to look at the Fannie Mae guidelines for the conventional loans, and also listen to these items that we listed here for you.
Okay.
And now, what is the mortgage requirement is for this type of mortgage?
You have to have a 620 for a mortgage.
Exactly.
620 credit score. Sorry.
And then they say the minimum of the debt to income ratio maximum gonna be 45%, but it's still, this is not something that must be, you should talk to a lender about that. And
now, steady employment and the ability to you have to show your income and the ability to choose that you can support owning this home, as well as your housing costs plus a second mortgage.
Therefore, if you have a lower credit score,
you also have to prove that your parents cannot afford this on their own.
exactly.
And what do you want to say about the lower credit?
I'm just saying that if you basically you have a lower credit score, requires basically, if you have a lower credit score, requires a better DTI ratio and basically higher down payments.
Now, Fannie Mae does not specify lenders for the home opportunity mortgage, but it does provide the guidelines. And it's up to, of course, us, the children, to obtain these mortgages on the behalf of our parents. Now, if your parents are unable to work because they're, retired, they do not have sufficient income for mortgage on their own, their children can be considered an owner-occupant. If the Fannie Mae similar guidelines also for legal guardians for handicapped and disabled children, very similar.
Exactly. And
the loan can be based solely on my income or your income and the elderly's income. It is not necessarily required to be on the mortgage.
Exactly. I hope this video was helpful. Don't forget to subscribe in our channel, and see you in the next podcast and video.
All right, talk to you soon.